One thing also, before people dive in with questions, I can talk a little bit about the questions I have been asked in the last few weeks. Obviously, front of mind for everybody is the COVID-19 situation. And when we planned for this Republic equity crowdfunding round, we had no idea that this was going to be coming to a head literally when we launched. In fact, the timing of it was actually planned around this episode of Meet the Drapers, which is a fun show that if folks have not seen it, it's kind of like a goofy version of Shark Tank with Tim Draper and his family as the panel. And Patrice and I got to do a pitch there and had some really good interactions, and I think it was really worthwhile. So if folks have not seen that yet, we're happy to share out the URL for that. But there are definitely worthwhile reasons why we timed this when we did. But I think if we'd known the kind of perfect storm of wild swings in the economic environment that were going to happen, we could have picked better in terms of launch dates. That being said, there are a lot of both scary and encouraging aspects to the timing. And so one of the things that I've been telling our team is that, in a sense, it is now a race between how well we execute on our plans for April and May, which were very ambitious. So we have a number of product rollouts, a number of major partnerships that we're planning to roll out. So we're working on all of this, and in parallel with that, of course, world economic activity is really going through a kind of bubble where, for probably 60 days in each economy, very little of the usual activity will occur. And you've already seen some of this for instance, in China. I don't know if everyone saw the satellite maps of the pollution levels, but China went from being one of the most polluted places on Earth to being clear blue skies and pastoral for like a 2-month period as they resolve the crisis there. And I think if you look at the global economy, you can probably anticipate similar kinds of statistics in each of the countries in turn as they sort this out. So effectively, that makes 2020 a 10-month year. And the challenge for, I think, any technology startup is twofold. One is to just motor through that. And the second is, in our case, we have some very unique advantages to our products that feed into emerging needs during this period. So the big things that we have going for us are support for remote work, where people can take huge video files, 4K, 8K video files, and manage them through their browser from home. That is a massive capability, and for most of our customers that already have the system, it's a very easy thing to enable. They just basically change a few settings in Axle, and then we help them with a little bit of configuration, and they're up and running. But it's also a great opportunity to target a whole bunch of new customers who may not have thought about Axle or similar products previously, but now can basically get remote access for their post-production teams. So that's a really big potential win for us, and it's global. The second big win is the trend towards automation, where everyone's trying to figure out how to get the same amount of work through, but with fewer people, and in some cases no people on premise. So they're looking for tools that will help them automate their video workflows, and this is where our second product line, Connector, comes in. It's already been very helpful in closing a number of large deals at places like Mediaset in Italy or Telefonica in Spain, where we literally would not have gotten the deal without Connector, but it was kind of rarefied where you had to know what you were doing to ask for it. Now that automation is one of the buzzwords that's kind of front of mind for many media creation shops, I think Connector could really blossom in its own right. And so we're going to be pushing on that very hard in the next couple of months. So So we have some kind of counter-cyclical growth opportunities that should stand us in good stead. And meanwhile, it's mostly about weathering the storm and not adding any unnecessary costs during this period. So that's kind of our approach to it. And in that sense, the crowdfunding round is very timely, because if we get a little extra money in the door as a result of doing this, that would be sort of an enabler across the board. We can use it for marketing and getting the word out for these capabilities at a time when really folks are at home and very receptive to hearing about new products. So that's kind of my assessment in a nutshell, but not to in any way downplay the severity of the economic impact. It's going to be massive. So, any questions?
It's Mick Thompson, president of Panorama Capital Corp. I'm just wondering, in light of COVID-19, what's your current cash position, and have you scaled your burn rate down? And sort of wondering what cash position to burn rate. And otherwise, if things continue to be murky in terms of confinement and isolation and what have you, how long can you last in your current burn rate?
Yep. So first and foremost, our cash position is usually quite low. It's usually in the low tens of thousands of dollars, and now is no exception. So we don't have much of a war chest, if any. That said, we have a fairly steady stream of business, so we're comfortable in navigating the next 30 to 60 days. Certainly, if things were to dry up, like if everything were to screech to a halt, we have quite a bit of flexibility in our operating costs. We don't pay any rent because we're a distributed company to begin with, and we don't really have any point vulnerabilities in terms of, since we're not used to working in the same office anyway, it's not as if internally we're taking any efficiency hits as a result of this. But we are definitely vulnerable to a sharper downturn. If things were to literally go to a halt and we had no revenue coming in the door at all, then I think the sacrifices we would have to ask of our employees would start to get more dramatic. So as it is right now, we feel like we can weather it, and we don't believe that we need to do any layoffs. The key is that right now everyone is pulling their weight. I'm not saying equally, but about half the company is focused on the customer-facing side, and the other half is focused on delivering the products and the upgrades, for each incremental product release. We also have some big product releases, and as I mentioned, these big strategic partnerships that are expected. At least one of them will launch in May. So we have to keep all of that activity on track, and that means that our R&D side is I don't want to say immune to reductions, but it's also the case that it's very affordable. Most of our development team is in Latvia, and their cost structure and their pay scales are very modest. So I feel like between the customer-facing team that's mostly in the U.S. and a little bit in Western Europe, and the dev team that's mostly in Eastern Europe, we don't see a need for a headcount reduction yet. And in fact, if we were to do that, unfortunately, we're already kind of pretty bare bones, so that if we were to lose one or two people, for instance, those would likely be at the expense of some revenue that could have paid for them. So I'm always looking for that, and we did shed a couple of people earlier this year, where we they were more like personnel decisions rather than a broader economic imperative, but we have not replaced those. So as it is, everyone's particularly on technical support, we have folks working some crazy hours because we let one guy go, and we also had one field guy that didn't work out. So, it's inconceivable that we could reduce the staffing there without impacting our ability to deliver new installs and generate revenue. So that's the kind of thing we're looking at across the board, though, and we're always open to it.
Thank you.
Ed and Jen, I know you both. Thank you for joining. Feel free to, this is an informal call. I mean, it is being recorded, so there is that. But feel free to ask any question that you think could be informative to folks in a wider audience. And, happy to also, by the way, if we prefer to keep the call short, we had obviously penciled in an hour, but if it ends up being more like a half-hour call, we're more than happy to hand folks their time back. But just want to make sure that we're answering whatever questions are out there.
Sam, it's Mick again. I don't want to hog the call, but seeing as
no one go for it. Go for it.
Asking the questions. And for Ed and Jen, Panorama Capital Corp is a capital pool company. It's listed on the TSX Venture Exchange, and Sam and I were connected via the TSX Venture Exchange, and so I've had a lot of experience in the arena. I did see the piece on Meet the Drapers. I thought it was very good, actually. Both of you present very well. I laughed when they were putting the makeup on you because it looked like a small show, but when I saw the makeup, I thought they're doing things right. For those who haven't been on TV, A, TV is way tougher to do than most people think, and B, on my time, I could have used some makeup. So, as an aside, but I did notice on the show a couple things were mentioned, and I think it's important for investors. One, you call yourself a startup, but really, according to the show and the video, you've been around since 2012, but it's only since artificial intelligence or AI took off that really your product has come into the forefront. And as a corollary to that, wondering when you move to sort of morph into a SaaS company, what's software as a service company or SaaS, what the time frame for that is. And I imagine that's when you get your PC and Mac platform, and wondering about the scale of the company. I mean, how do you take this? It's, for a company your stage of development, almost $1 million in sales is great, but how do you scale that up, and how quickly is the ramp? And now I realize I'm asking about 5 different questions.
No, that's great. Happy to answer them in turn.
Yeah, I kind of like to
get
a feel for that, of those so-called hockey stick numbers, and where that inflection point is in terms of timing, and how you see it being different as a SaaS product. And I take it you'll drive better margins, and that will let you increase sales exponentially.
Yeah, well, thank you. No, so first of all, maybe let me answer the question about the history of the company. So you're exactly right. I mean, for the first 5 years we were in business, we did not feel it was an investment opportunity. I funded the company myself. And there was quite a bit of sweat equity, which is actually represented as options on our cap table by Patrice and the rest of the team. Our feeling was that this was an interesting boutique business, but not likely to reach the kind of growth rates that would be attractive to a venture investor. And that was pretty much our position all the way until mid-2018. And at that time, 2 things started to happen. First of all, the groundswell of video adoption really started to ramp up, and it was clear that everybody was doing video all the time. And the second thing was that AI, which had been an interesting curiosity for decades, really started to work on video. And you could say, wow, all this video is getting shot by all these people, and for the first time ever, it's something you might be able to search. And those things all coming together at once led us to do 2 things. First of all, we did rebranding at that point. Prior to 2018, the company was called Axle Video, and so we rebranded as Axle AI in early 2018. And the second thing is we started looking for outside investment, first with accelerators, and then more recently, obviously through Republic, or perhaps through other vehicles going forward. It's turned out to be, I think, the right timing, because things clearly are taking off. And so if we just sat there as an interesting boutique company, it's not clear how much of a future that would have. It might grow 10 or 15% a year, but you have to invest to grow faster than that. And you have to bear in mind also that this was literally run at or near break even up to that point. So we said, hey, let's lean into this a little bit. Let's do an accelerator. And we first did Quake in New York, and then we did Launch in San Francisco. Both were great experiences, and actually exposed us to a lot of partners and potential investors, and also where we polished our pitch. Like, had we not done that, and if we'd gone on Meet the Drapers, we would have been mincemeat. I think, as it turned out, we did pretty well. And by the way, we seem to do well at pitch competitions whenever, like, we seem to either win or get runner-up in almost every competition we go to nowadays. So people understand now what's happening, and I think we've gotten better at explaining it at a high level. We also have developed things like the 30-second marketing piece with the guy walking and the folks juggling and all that, which again puts in more layperson's terms the value that we provide and what we are as a company. So with all of that said, even though the company's been around for 7+ years, it's really only been the last 2 years where we've seen this growth potential. And during that same period, we went from a 1-product company to a 3-product company. So we acquired the connector product again in 2018 and have since developed it quite a bit, but I think that's worked out really well for us. And then late last year, we introduced our 3rd product, which is Ascribe.ai. And that is what we were talking about on the Draper show as AX1. That was our kind of internal code name for it. But essentially, we're starting to develop capabilities on an individual laptop connected to the cloud that mean that you no longer have to install a centralized server and spend thousands of dollars. We've always been pioneers at that, in the sense that the existing media management companies would expect you to spend hundreds of thousands of dollars, and here we were saying, oh, actually 5 or 10 or 15,000 should get you started. But even that is a high hurdle for a freelancer or a 2-person team. So there are so many more of those with the advent of YouTube and all the kind of run and gun video opportunities that are out there. So with Ascribe, we feel like we're targeting that wider audience for the first time. So that's been a very helpful progression to us, and that revenue is almost all SaaS revenue, whereas the existing revenue has been largely upfront purchases. Very high margin, of course. I mean, 90% is nothing to sneeze at, but it's still one-time purchases which do not have the equity multiple of a SaaS revenue stream. And I won't get into an argument as whether that's fair or not. It's just the way the world works. So investors these days are very geared towards SaaS, and we understand that. It also correlates with mass market appeal, because obviously if you say this is going to cost $2,900, that's a big commitment and a big spend for a small freelancer. If you say it's $29 a month for the next 5 years, most people will say, sure, sign me up. And so there are reasons why SaaS is good for both the end customer and for the investor, in that it creates a much more predictable revenue stream. So we're on board for that. Now, having said that, the timing of our transition to SaaS and the rate at which we will move from primarily CapEx with a subset of our revenue that is recurring to primarily recurring with a subset that's CapEx depends more than anything on financing, because it's very hard to do without a cushion. As you can imagine, the company is literally run on cash flow. And let's say in a typical month last year, we did about $855,000 for the year. Each month we were doing, say, $70,000 worth of revenue. If we were to amortize that and say, oh, let's just make it all SaaS and push it out over the next 36 months, we would be out of money in a matter of weeks, because essentially we're taking these big chunks. People are paying us $20,000, $25,000 at a go, and turn that into a dribble of $499 a month for the next few years. So it's a decision that we've actually had to turn away from a couple of times, where customers said, listen, I would prefer to do this as SaaS, and we've had to say, yes, but we can't afford to do that unless we have deeper pockets. So one of our intents with raising capital is to create enough of a war chest that we can take these incoming deals that could go either SaaS or one time, and preferentially do them as SaaS, because it has a higher multiple, but you can only do that if you have the deep pockets. So hopefully that answers. I think I covered most of your questions. There was one other also buried in there, which was the hockey stick, the question of what is the anticipated growth rate. We were projecting kind of 1 point, and actually, you know what, I probably should only talk in generalities because the Republic site doesn't have projections on it, and you know, it's almost like a miniature IPO in a sense, in that you have disclosure requirements. So let's say we were planning to grow significantly in 2020 and even more significantly in 2021. I do think it's a very appealing story for investors, and that you can imagine this company being several times bigger than it is today, without sharing exact numbers. And you know, we even have investors like Jason Calacanis. He doesn't invest in things unless he believes they can be unicorns. So he thinks we could be $1 billion company, which is incredibly flattering. That being said, I've had conversations with him. I'm like, Jason, you know, we think this is going to be a big success, but really, you think this is a unicorn? And he says, well, do you think you could be $100 million company someday? And I'm like, yeah, absolutely. He says, well, if you think you could be $100 million company someday, you just need to hold on a few more years, and then you'll be a unicorn. So I think that's a great way to look at it. And you know, more than anything, at the Launch Accelerator, what they preached and what we really appreciated was just keep at it. You know, keep banging away. If one quarter's results or one year's results don't have the pop in the numbers that you were looking for, fine tune what you're doing. You know, expand your reach, keep going. But above all, you know, don't develop a huge burn rate, and don't do anything stupid such that you have to go out of business or sell out. And I think that aligns really well with our approach. You know, we're just kind of down to earth, get it done, folks. We're not trying to do anything wild and speculative. We believe that if we keep at this, and we've already been at it for 7 years, if we keep at it for the next 3, 4, 5 years, we're going to build a really substantial company that is right at a hotspot intersection of two of the biggest things happening, which are AI and video. As to whether that's a 50 million or 100 million or $1 billion company, I leave that to everyone to speculate, but we think we can do some pretty great things.
Just adding some to all your comments, you know, for Mick, the reason we are expecting the growth is because now that we are coming up toward consumer market, in addition to the business/enterprise market, which is where the Axle AI piece has been, you know, has been targeting in a way for the sales. With the Ascribe and everything else, we are coming also toward the consumer. So you have suddenly thousands more of people that can actually utilize that technology versus just video teams, which are in the hundreds of thousands. But you know, we're not talking about the magnitude of every video bloggers and all of that.
Yeah, that's a really good point. And in fact, this transition is similar to the one that I've experienced moving from Avid to Axle, because at Avid, we had a total global target market of about 5,000 potential sites. And we had like 40% market share. Like when I left Avid, we had close to 2,000 sites out of the 5,000. And there wasn't a whole lot of room to grow because there were a lot of regional competitors, and you'd had Sony in Asia, and you had Grass Valley that was strong in some markets. So 40% was pretty close to saturation of that big broadcaster world. But what was clear to me was that all of this other stuff was happening at the next level down. And even at Axle, I'd say we've still only scratched the surface. There are 300,000 of these teams, and we sold to about 600 of them. So there's a very big opportunity right in the midsection of the market where we are. But to Patrice's point, what the Ascribe product does is it gives us a kind of feeder or funnel where we're reaching hundreds and hundreds of new prospects. I think we've generated more prospects and more signups with Ascribe in the last 4 months, 3.5 months, than we did in the entire preceding year with Axle. So, and of course, the Axle leads continue, but now we have all these folks that, oh, you know, a little bit of transcription, a little bit of searchability would be great, and then they tinker with it, and over time they can make a decision whether to, let's say, move from a $10 a month spend level to maybe a $100 to $300 a month spend level that would correspond to our flagship product.
Sam, jumping in, we have a
there's
question.
A question.
Yeah,
yes, thanks. Thanks, Ed. Yeah, great. Where do you stand on the current list offer to investors? When you say list offer, I mean the Republic offering, the details are spelled out on the Republic site, and it's www.republic.co/Axle, AXLE -AI. So when you say list offer, essentially it is a safe note, so it is not interest bearing. It's at a $7 million cap and a 20% discount to whatever the next equity round is. We've already seen a nice little grassroots, I think there's like 17 investors on there, and I've just been hearing that there's some more folks that will be signing up fairly soon. So we feel like, it's appropriately priced, and that, partly because of the protections of the note structure, even if there's a modest downturn in equity valuations, for instance, the cap, essentially you're covered if equity prices go down, and you're covered if equity prices go up because you've got a cap. So you will be in good shape, hopefully, with either dynamic. One thing that we are planning to do is hold this call at least every other week, and for the short term, I think we're going to do it weekly, just so that, especially in this time of crisis, that people feel like there's some sense of availability to our management. So it may be me plus Katie Scott, who is our VP of Operations, or perhaps Neil Blake, who handles Europe for us. But I think for the next few weeks, we're going to try and do this same time on Mondays, and just have a kind of an open forum so that people feel like they can come in, learn a bit, come back a week later, and assess things on an ongoing basis. One of my earliest experiences at trade shows, and this dates me a little bit, but it was probably the late '90s or early 2000s. I was at a trade show with a startup, and somebody came by the booth and said, "This all sounds cool, but how do I know you're even going to be here in a year?" And I thought about it. It was our debut. It was our first trade show, and I was like, I don't really know what to say. I said, "I tell you what, come back next year, and if we're still here, you'll have your answer." And sure enough, that guy did come back the next year, and he ended up buying our product. And sometimes that's all you could do, is just say, that sense of continuity and consistency is very important, both to investors and to customers. And I think it's always been one of our strengths at Axle. Patrice and I have worked together before. The broader team, we've all done at least somewhat relevant work to this before, and a number of us have worked directly together in very similar roles before. So, this isn't one of these flash in the pan things. We're a couple of recent college grads, and we're just winging it and trying to build the next unicorn. It's really a consistent body of work, in some cases measured in decades. And as just an example, if you take the code bases for Axle AI, Ascribe, and Connector, I did the math, and it represents about 60 person years of technical development of just coding work, and that's leaving aside the support, QA, all the other things that we do at our company. So that's a big, substantial body of work, and I think the more we can provide ongoing visibility, not only into the product itself, but also some of the customer developments and market dynamics, the better it will be for investors who are thinking about participating in the crowdfunding round. All right, well, let's see. We're coming up on 40 minutes after. Why don't we give one last open call for questions? And if there are no additional questions, we can adjourn until next week's call. If you'd like to sign back in, that would be great. Also, by the way, I love the geographic reach. We've got one person from Canada, one person from Berlin, so hopefully we can continue that. And I can only imagine, I mean, it's so unusual to have this kind of a global extreme situation. And in a way, it's been very reassuring to see the way so many different cultures and countries have been able to come together with some pretty impressive responses. I don't know where the time horizon is on this, and to be clear, maybe I didn't emphasize it enough in my earlier comments, but like this is going to be a massive, massive economic shock. It already is, but we have not seen the depth of it yet. And so our number one goal as Axle is to, again, do what we can to help our customers and to acquire new customers in this time, and then just to kind of get through it in a really strong position, which I will say Patrice and his team have totally set us up for, because we have some great product rollouts very imminent. The first one will be announced this week, and then we have more coming over the course of April and into May. So, we're doing what we can do, making sure we get through it. And actually our earliest seed investor, Dave Feldman, has always described me as his favorite cockroach, which I used to take as an insult. But at times like these, I think we have to view it as a high compliment. So his attitude was like, Sam, you and your team, you guys can get through anything. And, I think that should stand us in good stead over the next few months. But the opportunities are uncharacteristically huge right now. So if we execute well, we're going to come out in pretty amazing shape. So with that, unless there are further questions, I think we're going to wrap. But going once, one person is asking for a demo. We can definitely do that, of course. For any kind of sort of interactive stuff, feel free to contact me or Patrice directly. That is always an option, especially on the product side. Obviously, we're not allowed to discuss aspects of the fundraising in a private forum, but product demos, absolutely. Delighted to do that. And perhaps on next week's call, actually, now that I think about it, Patrice, maybe we could kick off next week's call with a bit of a product demo.
Yeah.
I think that would be a good idea.
Yeah, definitely. And also show the general public product where we're at and so on. Yeah, I think it will be good.
Yeah.
Make it more tangible for the investors.
Yes, absolutely. So we will do that. On next week's call, we will include a product demo. And I think maybe we could do that once per call. Like maybe next week we show the new Axle 2020. The week after that, we could show Connector. The week after that, we could show a Scribe, something like that. Or we can vary the order. So that's a great suggestion. All right. Well, thanks again, everybody. Really, really appreciate it. And have a great week. Have a safe week. And let's motor through this and look forward to looking back on it.
Thank you both.
Thanks, everybody.
Thank you very much. Bye now.
Appreciate it.